Good morning, ladies and gentlemen. Today we're going to talk about your team Rotman Capital, comprised of Nelson, Z, Christina, and Yuthan. Today we're going to talk about the fair value opinion for Shaker Inc. Now, we've been engaged by Lori Animal Feed, LAF, which is one of the leading suppliers in pork feed and dairy cattle feed. Shaker Inc. is also operating in similar segments, both, as you can tell, there's overlap in its main divisions, with the addition of the dairy quota portfolio, which we'll analyze separately. Our recommendation for the combined entity, including the portfolio, would be $83 million equity for fair value, with potential takeover value of $92 million. The $83 million is based on the case inputs, and we believe that's the, textbook fair value. However, based on some assumptions that we thought were a little bit more realistic, we would have a takeover value at $92 million for the equity of the company. This is based on a revised assumption on labor, and also excludes any possible synergies that might be possible because of that takeover. Now, we use several valuation methods. We use the comparables method and the DCF method under different scenarios. We use the comparables method under the base scenario, which is based on the current year's peers, EV over EBITDA multiple. And then we also looked at the forward multiple, but that's also based on the peers' current multiples. The reason for this mismatch is because we don't have the forward multiples for the peer companies. However, we want to take into account the fact that the pork feed division is growing significantly, and therefore the current year's EBITDA will not be representative of the true value in the company. We'll talk about this more when we go to comparables, and we also did DCF, the discounted cash flow method analysis under the case revised scenario, which excluded the labor component, and also a hybrid ability to pay scenario, which we'll go into further details in a bit. Now, first we want to analyze the milk quotas, which is actually the simplest part of the analysis. So for the milk quota, it's generating $270,000 in after-tax profit for the company. And we believe that in a sale, assuming it would be liable for capital gains tax at 30%, it'd be worth $8.7 million. Now, the reason why we use 30% is because it might, so on one hand, it might not be taxed at all, depending on, how the tax system works on the quotas. Or it might be taxed at a higher rate, which usually applies for capital gains and investments, capital gains on investments for corporations. So we use 30% as more of a corporate tax rate as a simplification. Now, assuming it will be taxed, it'd be worth $8.7 million. If it wouldn't be taxed, then it'd be worth $12.4 million. But even at the lower end of the value, you can tell that the internal rates of return for that milk quota for its revenue versus its sale is actually very low. So based on that, we recommend a sale, and also for the reason that in the case the milk quota regime is liberalized, the milk quota prices would plunge, and therefore it'd be a good idea to exit now. Now we look at the market comparables methodology, and for that we looked, as mentioned before, we looked at the base case. So what we did was we unlevered the betas so that we can actually compare it, and we used the peer set in order to imply a beta for Shaker Inc., which is later on used to calculate the weighted average cost of capital. Now, one thing you'll notice is that for the peer comparison group, we used these three companies. And the reason for that is that they're the major competitors for LAF. And also that we didn't want to include the companies that are listed on the New York Stock Exchange because it's a different regime in the US. So therefore, we want to make sure that the comparison companies are comparable. And also, these are the leading companies as well. So we have some statistics on the median and mean and the low and high for the overall group. And then we did a selection based on just the three companies that we mentioned for the reasons that of being relative peer. And when we did that, we came up with an equity value of $28.2 million, including the $8.7 million in the milk quota, using the base case, and labor beta of 0.877. Now that beta is low because, as compared to other companies, the debt level of Shaker Inc. is actually very low. We also did another scenario where we looked at Shaker Inc.'s 2017 projected EBITDA values. And when we used that, we came up with a value of 70.8 million for the equity value, which includes the multiple at 8.7 million. Now, one thing to note is that ideally, when we use a projected forward number, we also need to project forward multiple, but we don't have that. But at the same time, we believe that this captures a large part of the value that should be captured, because there's under the assumption, of course, that the companies in the peer set, LEF, Big Feet, and Feed R Us, don't have a significant expansion plan that essentially more than doubles their pork feed production from 35 million tons to 85 million tons. We use 2017 because it's in the mid part of the wrapping up stage. So that's why we don't capture the full value of the expansion, but we capture part of the value, which we believe is fair. Now we go into the calculation of the weighted average cost of capital. It's pretty much a straightforward calculation with the cost of equity, including the size premium of 5% that was given in the case. And this and the target gearing of 21.6% is based on the implied value from the comparable side. We end up with a weighted average cost of capital of 10.33%. And then we use that in our valuation, which, as you can see, for the base case, we have a value of $83 million, and that's using the assumption that after 2019, labor is growing at 5%, labor costs is growing at 5% per year. However, under that assumption, we can't actually use a perpetual growth model, or because essentially that assumption that which we're given in the case of 5% labor costs increases per year would actually mean that the company would stop being profitable after the year 2039. So therefore, the company is actually going to go bankrupt. And apparently, if that assumption was true for all companies, and we can't assume the proportionate increase in revenue, all the companies actually go bankrupt. So we felt that was a little bit unrealistic. So we actually used one where after 2019, we assumed it was a stable cash flow, and we did an exit there, which is represented by the terminal value growth values here. So it takes 2015-2019 DCF that's standard in all both the methods. But at 2019 onwards, we assumed that the free cash flow would be constant, growing at 2% per year, and discounted at the WACC. So it's the Quota growth perpetual growth model. And then we also use the exit multiple as well, where we assume the exit multiple of 5.5, which is the current multiple that we have, not really a forward multiple, but without further information in the case, it's hard to come up with a forward multiple. Generally, a forward multiple we could derive based on equity analyst estimates, which again, for a fictional company, we don't actually have. Now, under this, we chose the exit multiple for the pork feed division because it's not very stable. As we saw, there was a large increase in production. Labor costs are controversial, so that's why we used the exit multiple, which takes into account that variability and is market-based. Whereas for the dairy cattle, it's a very stable business, so therefore we can actually use the golden growth model, which assumes stable future cash flows. And when we use that, we come up with a value of $92 million with equity, which again includes the $8.7 million value from the low quotas. So the DCF, we used it since we used the WACC, we would calculate the enterprise value, and that's why we minus out the debt in order to get to the equity value. Now, we also did a hybrid approach where we noticed that the management was willing to pay $1.10 for every ton of capacity for the pork feed plants. And under that, for 85 million tons of capacity, they'd be willing to pay $93.5 million. And then we used the dairy feed and milk quotas from the analysis, and we come up with a value of 104 million. One thing to note is that 85 million tons that's of capacity is actually a future capacity that's coming online, which we believe that a large part of it is already included in the cost of prior investments. We noticed that there was a 3.5 million capex, but that would have to be more of a continuance rather than a full cost. Now, the assumptions we used in discounted cash flow, you can see here, target gearing, depreciation base, to find out how much depreciation we should use. We were only given partial financial statements of the income statement, so we didn't know how much current capital stock they have in order to depreciate or capital depreciation schedule. So we made some assumptions, and we also got some assumptions from the case itself already. So this shows the assumptions that we used and also why we used them. Now, we looked at the pork feed income statement. We looked at projections. We revised the production projections. So you can see the ramp up over there. So it doesn't ramp up fully. And you also see that the revenue per ton and the grain cost is using the revised LAF estimates, which we believe are more reliable than Shaker Inc.'s own estimates. And we also implemented the labor cost increases that were discussed in the case as well. For depreciation, we created a depreciation schedule, which is a simplified schedule, but we believe this is a good approximation. And interest expense, we assume the cost because we're not taking on any more debt or retiring debt. So we assume perpetual roller of debt at the same rates. For dairy cattle, we used revenue per ton figures, which was an average of the historical 5 years, and projected the cost going forward. For labor, we took into account what was discussed in terms of the 50% increase in 2019 and beyond. And for 2015, we had that increase as well, based on the new contract. We took out the milk quota expenses because we took out the revenue and we valued that separately. We also excluded Carrie Shirkston $40,000 of tuition and living expenses. We believe that's not a core operational expense, and also it won't be going on in the future. One thing for both of these income statements is that we actually projected it up beyond 2019, so we didn't just cut it off. Because of the labor assumption that was given of growing 5% per year in labor costs, eventually, after a certain number of years, I believe it's 2039, it actually ends up being a negative income. So that's why we projected out instead of just assuming perpetual growth under the case scenario. And then which we'll discuss further here. So when we actually did the DCF, you can tell that when we did the quoting growth and the next month, we ended it off here. But for the full, for the case, we actually projected all the way outwards until it became negative. And we assumed that once earnings were negative, and since it was continuing to be more negative, we assumed that the company was shut down at that point in time. We did the same thing here for the dairy cattle discount cash flow analysis. So you can see that the golden growth mix multiples valuation there. That's all discounted, of course. And thank you. So to close it up, our fair value recommendation for the equity value, our opinion is $83 million. And that's based on the case inputs and the assumptions given. With a takeover value recommendation of $92 million for the equity value, that's based on revised labor assumptions that we believe are more realistic. And also this excludes synergies, which would have to be factored in terms of the takeover price as well. But as mentioned, we're more of giving a fair value opinion rather than a takeover M&A case opinion. If you have any questions, please do ask, and we'd be happy to answer them. Thank you.